If your business is importing any kind of machinery or capital assets, you already know that currency fluctuations can be a real headache. Well, today we're going to demystify Section 42 of the Income Tax Act 2025. This is the rule that tells you exactly how to handle those foreign exchange shifts for your tax calculations.
So let's just put ourselves in a very common business situation. Your company imports a critical piece of machinery, right? You agree on a price in, say, dollars or euros. But by the time you actually make the payment a few months later, the exchange rate has moved. So what's the real cost of that asset for your tax books? That's the big question we're tackling today.
And that exact problem is precisely what Section 42 is built to solve. It gives us a clear, structured way to handle these currency ups and downs. So let's get right into it and break down how it all works.
Here's a quick look at what we'll cover. First, we'll talk about the business problem itself. Then we'll introduce Section 42, the legal fix. We'll explain the mechanics of the adjustment, walk through a practical example, cover the all-important compliance do's and don'ts, and wrap up with the key things you need to remember.
Okay, first things first. Let's really nail down the core business problem that this section addresses.
So picture this. An Indian company buys some essential machinery from a supplier in Germany for 100,000 euros. Payment isn't due right away. It's due in 3 months. Now, in that 3-month window, the rupee-euro exchange rate could swing up or down. This creates a huge uncertainty, doesn't it? For your tax calculations, is the machine's cost based on the rate when you bought it or the rate when you paid for it?
And to cut through that uncertainty, the law steps in. So let's get into the legal framework provided by Section 42.
So Section 42 gives us a very clear rule. It basically says that if your liability in Indian rupees changes because of forex fluctuations when you pay for an asset you've bought from outside India, you must adjust the asset's cost. The most important phrase here, and you'll hear me say it again, is that the adjustment happens at the time of payment.
So, you might be asking, when does this actually apply to my business? Well, you've got to tick 4 boxes. 1, you're acquiring an asset from outside India. 2, it's for your business or profession. 3, the bill is in a foreign currency. And 4, the exchange rate has actually changed between the acquisition date and the payment date.
Now, for all the seasoned professionals watching, this probably sounds very familiar, right? And you'd be correct. Section 42 of the 2025 Act is essentially carrying forward the same core principle we had in Section 43A of the old Income Tax Act of 1961. The fundamental idea is the same, which is great for continuity.
Okay, let's get into the nitty-gritty. How does this cost adjustment actually work on your books? The process is actually pretty logical. You start by calculating what you owed in rupees on the day you acquire the asset. Then you calculate what you actually paid in rupees on the payment date. It's a two-way street. If the rupee weakened and your liability went up, you add that difference to the asset's cost. But if the rupee strengthened and your liability went down, you deduct that difference. Simple as that.
But wait, there's a really important exception here that savvy businesses use all the time: forward contracts. If you've used a forward contract to lock in an exchange rate to protect yourself, Section 42, subsection 4 says you have to use that locked-in rate for your adjustment, not the spot rate on the day you paid. It's the law's way of recognizing this common hedging practice.
All right, enough with the theory. Let's make this real. We're going to walk through a practical example to see exactly how this plays out. Remember that company we talked about earlier, the one importing the machine? Let's check back in with them. And just to keep the numbers nice and clean, let's say the final invoice was for 100,000 US dollars.
Okay, have a look at the numbers. On the date of purchase, the exchange rate is 82 rupees to the dollar. So the initial cost on the books is 82 lakh rupees. But a few months later, on the payment date, the rupee has weakened to 84. Now that same $100,000 cost them 84 lakh rupees to pay off. That difference of 2 lakh rupees, that is your adjustment under Section 42. You add it to the initial cost, and voila, your new revised actual cost is 84 lakh rupees.
And this is the whole point. This is the so what. That revised cost of 84 lakh rupees is now your new starting point for calculating depreciation. A higher cost base means you can claim more depreciation each year, which of course reduces your taxable income down the line. It has a direct impact on your tax bill.
So we know the what and the why. Now let's talk about the how. How do you make sure you get this right? And what are the common mistakes you absolutely need to avoid?
Okay, let's run through the compliance checklist. First, and this is non-negotiable, you only make the adjustment when the payment actually happens, and you do it in the tax year of that payment. Second,
Your mantra should be document, document, document. Keep crystal clear records of all dates and rates. And finally, as soon as you make that adjustment, update your fixed asset register and recalculate your depreciation.
Now here's where people often trip up. The biggest mistake is confusing accounting rules with tax law. Your accounting standards might require you to restate the liability at the year-end rate, but for tax purposes under Section 42, the only trigger is payment. Also, make sure this is only for capital assets, not revenue expenses or working capital loans. And of course, if you have a forward contract, you must use that rate. Lastly, remember this adjustment affects the written down value of the entire block of assets, not just the single asset in isolation.
All right, we've covered a lot of ground, so let's just boil it all down to the absolute essentials you need to walk away with.
So if you remember nothing else, remember these 5 things. 1. Section 42 is a mandatory cost adjustment for imported assets, and it's triggered by payment. 2. This adjustment directly impacts your future depreciation claims. 3. It's the new version of the old Section 43A, so the logic is consistent. 4. If you use a forward contract, you use that rate, period. And 5. Getting the timing and the documentation right is absolutely critical.
So, I'll leave you with a strategic thought. Now that you know exactly how these tax adjustments work, how could this knowledge influence your business's future strategies for importing and financing big-ticket items, especially in the kind of volatile currency markets we're seeing today?
And that's our breakdown of Section 42. I really hope you found it helpful. If you did, please share this explainer with any friends or colleagues who might also benefit, and be sure to subscribe for more deep dives into tax law. And just a quick disclaimer, this presentation is for educational purposes only and is not professional advice. Tax laws are always subject to change, so please consult with your professional advisor before taking any action. This is an AI-generated educational presentation.